Of the brief. When I started the brief, I decided to have fun. I decided to have fun investing and sharing this with everyone out there. At the same time, it was a good source for me to communicate with people what I wanted to communicate while I get questions daily. And sometimes I get bored re answering stuff. So I said, you know what? Whenever somebody asks me a question, I'll send him onto the brief. I didn't do that. I obviously continued re answering questions all day long. Now, today, I want to start really committing to that. I want to start committing to sending people to the brief to get answers to their questions as well as ask their questions. And here I am today on it's not the first session of the brief. It's the first of those sessions where I commit to sending people over here to the brief analyzing property, where we chat and we enjoy investing, learning about what we should do with a voice of reason. So it's a scientific approach. Today, as we know, everyone out there, and by the way, I just noticed that I forgot the microphone. So I'm not sure how much were you hearing me. I'll not fully plug it the right way now. I just will put it here so that I will not scratch much onto your ears. Everyone is talking about inflation, stagflation. Everyone is talking about the crisis, the coming crisis, the devaluation of assets and asset values. And there's too many questions in every investor's head. I'm no different. I do have the same questions, and they run in my head daily. And we may be slightly different. While I go to data and I try to avoid emotion, it doesn't mean that I'm not an emotional being. It means that I try to not allow my emotions to intervene with my investment decisions. So I do not react when investing, and react investing is painful usually. So what I try to do is try to be subtle when I'm investing, regardless of what the market is doing. So I'll give you an example. Today, I'm in a market which is booming on a real estate level, and you know that I'm a real estate investor. In my market today, it's booming, yet I see always the other side. So while people today are blinded by the boom that's there, I'm not, and I don't advise anyone to be. So, what I do advise people to do, and by the way, I'm here to take your questions as well. You can submit your questions on LinkedIn, on YouTube, on any of the channels that we're live on, and I'll hopefully see them, and I'll try to do that, and hopefully I will answer every single one of those questions. If I miss a question as it comes, what I will do is I will try to re-attend to it afterwards. We are on approximately 12 channels currently, so although that's not advisable usually because it spreads the viewership, I'm not hoping for millions of viewers. Everyone who's out there seeing, be it one, be it 10, I'm reflecting my views. I hope that it helps you. I'm using it in my investments, and it's doing good for me. It's doing well enough. So today we'll talk about the voice of reason. I'm in a market that is booming, a real estate that is booming, market that's booming. However, it will not boom forever. There are factors that allow it to thrive, and probably it will thrive for the considerable period to come. I'm talking about the Dubai market here. But if you're in the US, you're probably at a peak, and it's the top of the cliff in the real estate market, and for plenty of reasons. And now we'll talk about it. We'll talk about how people built. We'll talk about markets and markets similar to the UK market, which is dissected. It's not a singular market. London's market is different to the suburbs. However, in general, we'll talk about what drives all of those markets. So yes, there's a crash that's coming, and a crash similar to this crash have never been seen in the last 200 years. Actually, 1816 probably was the last time similar thing happened. Remember, it could not be the same because in 1816 there was no globalization. The world was not one pot of news dynamic and news sharing, and everyone was a reporter and everyone had an opinion. It was a totally different world out there. So this is happening today while there is globalization. However, will you sell all your assets and move to cash? Actually, there's two crashes coming. There's a crash in the asset values. There's also a crash in the currency values. And currency revaluations or failing is expected to come very soon. Actually, sovereign nations are expected to fail as well, not only economically, but way beyond that. The question is, what will come first? Will assets crash prior to currencies? Will currencies crash prior to assets? When and where? And by the way, I do not have the answers to those questions. I do have answers that would allow you, as similar to it allows me, to make choices that would put me in a good position regardless of what takes place, in a better position than taking the utmost wrong choice. And here I define a good position by saying a good position is one that allows you and me to take a better one. And if we take the right decision today, we have the tools tomorrow to take a better decision. If we don't, we won't. So let's talk about stagflation, hyperstagflation. There's inflation coming. Inflation has started in most of the world. Actually, inflation has never stopped. Yet, inflationary periods similar to today is when prices of goods start rising so fast and currency loses buying power this fast. And that is usually painful because it affects everyone and their livelihood. However, and that, by the way, improves the value of assets compared to currencies, especially assets that cash flow and that are utilized and used on a daily basis, similar to property. However, there is a fine line here between value driven investments that get affected that way and stagnation, which hurts asset values, specifically properties, specifically illiquid assets, and then the devaluation of assets that comes with deflation and the possibility of that taking place. Now, why does each of those dynamics take place? Let's start by inflation. What's happening now is shortage of supplies, overprinting of currencies. The US have printed 40% of the total currency money supply in circulation ever within the past 2 years. And that's painful, as well as the quantitative easing, which was ridiculously plentiful, as people could say. So all of this affects the value of currency and the buying power of currency, as well as the price of goods because of the supply shortage. And supply shortage is also driven by many elements. One of them is that people were able to buy plenty, and then driven by other elements, as well as by the fuel shortage currently, and by the oil crisis and the energy crisis, as well as by the war that is taking place or the wars that are taking place, because there's plenty of wars happening as we speak, not only arms war, but also beyond weapons. It's the economic wars that are launched and many other wars. So today, when we talk about all of this, it's supporting inflation. However, when governments tighten, they pull money out of the market. At the same time, they raise interest rates to make money more costly. People eventually will be out of their jobs. Companies will be spending less and making less and distributing less. Investors will be making less. Individuals will be making less money. The money cycle and the economic cycle actually gets harmed, as put into pain, and sometimes is crippled by that takes place. And this continues to take place usually in markets for 18 months, 24 months, depending on how long do the political intentions support it in many markets, as well as how long do central banks, or how long can central banks hold that for. And that affects the markets against inflation. So is it deflationary, or has a deflationary impact generally? Take with that the stagnation that's possible because people stop buying non-necessities. When people can't feed themselves and heat their houses, the necessities should be covered, and then they go for beyond. So they stop changing their phones so often, they stop buying their changing cars so often, they stop growing the house bigger, maintaining it, and again the economic cycle stagnates. And when that stagnates and is aligned with inflation or deflation, when it aligned with inflation, stagflation, or hyperstagflation when it's aligned with hyperinflation, which I do not expect is sustainable for a long period. So the risk here is stagnation with a head of or a tail of inflation and a head of deflation. And that's so dangerous because if it's stagflation and deflation taking place at the same time, when people cannot afford to run their businesses, run their lives, at the same time, they're affected by their reduced money power and income aligned with each other, they stop buying assets as much and they stop holding on to assets that they don't need or that don't generate generally. So, what would we do? I'm a real estate investor. My money is in real estate. What would I do? Should I be fully in real estate? I am mostly in real estate. So, yes, I have few investments here and there other than real estate, but in general, I stick to what I know and I understand well. And the rest is just not to call myself arrogant and believe only in my theories and ideas. They don't make me money, unfortunately. Probably I should do smarter choices there. However, they're doing well. And then the main is real estate and the cash flow it generates. And here you sit in a dilemma. If real estate is generating very high cash flows, and you know that you're in a market which is not the US market, it's the Dubai market, it's not on a high yet. And how would you define a high? You would look at where did it start and the bottom it started from, and how far did it go. And here I'm not talking about a unified market, because within the same Dubai market, there is properties that I believe are in bubble territory. There are properties that I believe are fairly valued, and there's properties that I believe have a gap to the market. And anyone that runs through that and looks at properties I purchased, for example, today, would understand the gap. And I'll tell you about my neighbor. I have a neighbor and a very good friend, and he wanted to buy a property, and that neighbor looked at property and was looking at property around. And when I guided him to where I was buying at that moment of time, and I didn't give him much because, when somebody asks me about that, I generally don't talk much. The gentleman discovered automatically and said, wow, there is a gap here. There is a serious gap, because that property that you're looking at is much cheaper than what it should be compared to everything else in the market, because it's relative. Yeah, what is cheap is cheap relative to something else. What is high price? It's high price relative to something else. There's properties that have not grown much in value, where there is opportunity because it's well positioned, and there's always reasoning. Why has it lagged and not grown in value so far? Will it grow that fast in the coming few months? I doubt it. Will it fall as much as property that have hiked by 100, 200, 300% in the past year or 2 years? Also, not really. So you're buying property there. If it's cash flowing right, and if it can continue to do that, you're well positioned. Now, here you talk about the asset and the asset value and the consistency of that asset performance from a value perspective as well as from a return perspective. And you see, can that asset keep most of its value? You can always have a drop in value of an asset. It's not the end of the world. Can it keep most of its value? And can it continue generating positive cash flow? And if you have the right portion of leverage, you're sitting in a good position. That doesn't mean you need to erode all your cash holdings and have no security fund, and have no, beyond the security fund, have no dimension of safety for your asset itself. Now, what I will be talking about next time, because I plan not to make any of those more than 15 minutes approximately, what I'll be talking about next time is specifically how should you treat your assets. So what should you do with your asset? How would you buy assets? If you are starting today or not, it does not matter. How would you rent your assets? How would you sell your assets? And how would you maintain that investment and grow it with time? I'll teach you something that I promise you would change your life after looking at it. I'll let you open your own bank within your home to make sure that your assets and the portfolio and the asset fund grows, performs well, and sustains for a long term. For today, I just want to tell you it's not only crash or boom, there is something in between. And crash will not last forever, and boom will not last forever. So be logical, be scientific. Do not be depressed, because I'm seeing too many people who are listening to global news depressed whenever I talk to my friends in Europe and the US. And I'm seeing people in my market here as if there's no tomorrow, booming with that excitement and enjoyment. Enjoy it, guys. Remember, there is tomorrow. And I say this for both parties. Be the voice of reason. I would tell you always no hype, scientific approach, depend on data. We'll talk about indicators next time, but we'll not talk much about the market in the coming session. We'll talk most about how should you treat your investment and how each of your investments is a standalone entity and should form a wealth generating aspect. And that is each investment or each few investments. Thank you all for joining. I hope I didn't bore you today. Welcome and see you then. I'm Makram Hani on The Brief.